Okay, let's dive into one of the biggest debates in all of investing. Should you go for growth or should you go for dividends? Seriously, this is a question that people have been arguing about for decades, but by the end of this, you're going to know exactly how to think about it for yourself.
But before we get into any of the fancy terms, let's just start with the most basic question of all. When you put your money to work, what job do you actually want it to do? Because really, it can only do one of two things. And that single choice, it shapes everything that comes after.
And here are those two jobs. On one side, your money can stay inside the company, working quietly in the background to build a much bigger pile of value for you down the road. On the other side, that money can be sent right back to you, like a paycheck. Tangible cash in your account. The key thing to remember is that a dollar can't be in two places at once. It's either working to grow or it's being paid out to you.
So let's put the official names on these two jobs. These are the two big investing styles we're talking about today: growth investing and dividend investing. They're just labels for those two choices we just looked at.
First up, you've got growth investing. This is where you tell your money your job is to build a bigger pile. The company takes every single penny of profit and plows it right back into the business, to build new products, to expand, to innovate. You're basically making a bet on the future, letting your money compound as fast as possible inside the company itself.
And then you have dividend investing. This is when you give your money that second job. Start paying me back now. These are usually older, more established companies that are already super profitable. They've kind of matured, so instead of reinvesting everything, they send a slice of those profits directly to you as cold, hard cash.
A really great way to think about this is to imagine they have personalities. A growth stock? That's your wild, ambitious friend with some crazy new idea. They don't have any money to give you now, but they're promising this huge payoff if their big plan actually works. And a dividend stock? Well, that's your reliable friend who always pays you back on time. They send you a little bit of money, steady and predictable.
All right, so now that we've met the players, let's put them head to head. Let's see how they really stack up against each other on the things that actually matter for your wallet.
This chart really breaks it down. With growth investing, how you make money is through the stock price going up, what they call price appreciation. You're buying into younger, innovative tech or AI companies, and your goal is to maximize your total net worth over the long haul. With dividend investing, your return is the cash flow. It's those dividend payments. You're buying into mature, stable companies, and the goal here is to create a predictable stream of income.
Now let's talk about something that is so important but often overlooked: taxes. With growth stocks, you only pay tax when you finally sell your shares. That means your money can grow completely undisturbed by taxes for years, maybe even decades, and that is a huge advantage for compounding. With dividend stocks, on the other hand, you get taxed on those dividends every single year they're paid out. This creates a little bit of a tax drag that slows down your growth, even if you're just reinvesting that money right away.
But here's the thing. The best strategy on paper isn't always the best strategy in real life. We have to remember this quote because investing isn't just about math. We have to factor in the most unpredictable variable of all: us, human emotions.
And this number just drives that point home. A recent study found that a whopping 66%, that's 2/3 of investors, admitted to making an impulsive, emotional decision with their money that they later regretted. The truth is, when markets start to get crazy, it can make even the most logical person start to panic. And this is where dividend investing has a secret weapon. Think about it. When the market is crashing and the value of your portfolio is just plummeting, getting that steady, reliable dividend check in your account can be this powerful psychological anchor. It's a reminder that your investment is still working, still generating real cash. And that can make you way less likely to hit the panic button and sell at the absolute worst time.
And that mental stability might actually lead to better results in the real world. I mean, look at this data. It's pretty fascinating. Over a 50-year period from 1973 all the way to 2023, a big basket of dividend-paying stocks actually delivered a higher average annual return than the stocks that didn't pay dividends.
But hold on, let's pump the brakes for a second. We have to be really careful here. This kind of broad data includes a whole lot of failing companies, businesses that are just barely hanging on and, of course, aren't paying a dividend. You, as a smart investor, probably wouldn't touch those anyway, so it's not exactly a perfect apples-to-apples comparison.
So, with all of that in mind, what's the actual verdict for someone in their 20s or 30s? Well, you have the most powerful asset of all on your side: time. A really long time horizon. Let's see how that completely changes the game.
This number is just incredible. It comes from a 30-year simulation where someone invested the exact same amount of money every day into 2 different types of portfolios. And the result? At the end of 30 years, the portfolio that was tilted more towards growth ended up with $740,000 more than the one focused on income. That right there is the explosive power of long-term, uninterrupted compounding.
So here's the bottom line. If your main goal is to build the biggest possible pile of wealth over the next few decades, the math is pretty clear. A growth-focused strategy gives you the highest odds of getting there, simply by letting your money do its thing without that yearly tax drag from dividends.
But, and this is a really, really big but, that strategy only works if you can make a vow to yourself. You have to promise to stay the course for 20+ years. You have to be okay with watching your portfolio value get cut in half during a crash. And you have to swear you will not panic sell when things get ugly. If you can't honestly make that promise, then the psychological comfort of dividends might actually get you a better result in the long run.
Okay, now we've arrived at the final and honestly, the most important takeaway of all. This is not a binary choice. You don't have to pick a team and just stick with it forever. The smartest investors know that your strategy should change as your life changes.
And this quote just nails it perfectly. Think of it like a dial, not a light switch. You're not just flipping from growth to income. You're just adjusting the balance between the two. You're blending them together based on what you need at different stages of your life. And this is what that looks like over a lifetime. When you're in your 20s and 30s, you are in the accumulation phase. Your dial is cranked way up on growth. Then, as you move into your 40s and 50s, you start turning that dial toward the middle, balancing growth with a bit more income. And finally, when you're ready for retirement, you enter the distribution phase, and you turn that dial heavily towards income to help pay your bills.
So at the end of the day, the best strategy isn't about which one is better in a vacuum. It's about which mix is right for you, right now. Your timeline is long, your goals are your own. So the only real question left is, how are you going to set your dials?